In this short Bennett Explains video, I want to take on a fairly simple question. Is gold actually an investment or a gamble? There's been lots of volatility recently, so that's a question quite a few people must be asking themselves if they haven't done before. So, recent volatility, up to the point where this video was shot. It's been quite a bumpy ride. Going back over 5 years, using Bloomberg data, we've seen gold go, just going back 5 years, from sort of just over $1,100 per ounce, it's priced in dollars, all the way up to the heady heights of somewhere around $1,900, and all the way back down again. And the question people are asking, and will continue to ask, is, what next? So it's pretty volatile stuff. But if you're thinking, what next? Well, surely, we've hit some kind of 5-year floor there. No, we haven't. Things can get a lot more volatile in the commodities market than that, because if we were to look back as far as 1999, when the government, via Gordon Brown, sold off a big chunk of its gold reserves, uncannily catching almost the bottom of the market, the price then was just $280 per ounce. So you can see how far we've come since then. Now, to give you a feel for the fever, if you like, that hit this market in fairly recent times, in 2011 the price hit a recent peak of over $1,900. You saw that on the previous slide. At that point, the estimated assets under management of the biggest exchange traded fund for gold, that's a share that tracks gold, if you like, the AUM, the assets under management, were estimated to be higher than the same provider's S&P 500 equity tracker fund, which is itself the most popular ETF in the world by some measures. So people were piling into gold. And of course, for a lot of people, actually holding physical gold wasn't a practical way to do it. So they were buying a share that tracked the gold price instead. That just gives you a feel for the mania, the amount of money going in. And just to show that it can flow both ways, in 2009, gold demand from exchange-traded commodity providers, that's these shares that track the gold price, if you like, hit 623 tons. And by 2013, you had an equivalent net outflow. So just to give you a feel for the wall of money it can flow in, and just a few years later, the same wall of money flows out again. Conclusions. If you didn't know it already, commodities such as gold, and gold is not alone, are highly volatile. Although we've seen a recent bull market, they are in fact highly volatile, plenty of wobbles on the previous graph, and the market can be highly influenced by hot or speculative money. That's worth bearing in mind as we go through. So let's look at some of the issues around gold as an investment and then reach a conclusion about how, if indeed you should, you would go about using it. First of all, there's the income issue. Okay, and people debate this as to whether it's important, but I think it is important. Shares, bonds, cash, and property are different to gold. And that is why, for me, gold's never going to be a major part of a portfolio, because these four all pay an income. Dividends from shares, coupons from bonds, interest on cash, albeit not very much at the moment. And if you buy property as an investment, which isn't for everybody, I'm not talking about the one you live in, then you get rental income. Gold doesn't pay an income. And whether or not you think that's a problem, you cannot argue with one thing about that, which is it makes it pretty hard to value. Because the whole point is that an asset, without going into the textbook, is in theory worth all of the future income it generates discounted back to today's money. Well, if there isn't any future income, then as a gold bug, you are relying purely on capital gains. That's all you're going to get. There's no income, so any return you make is going to be pure capital gains. And that's a feature of gold that I don't like as a mainstream long-term investor. What drives the price? You might be thinking, well, surely, like any asset, is supply and demand. Yes, it is, but gold's a bit of a weird one, right? The price of any asset is ultimately a balance between supply and demand. More supply, less demand, price falls. More demand, less supply, the price rises, all right? But people do seem to struggle with what the supply of gold is. Now, clearly, it's difficult to fake it. You can't make it up and create it in a lab very easily, but nonetheless, no one seems to know quite how much of the stuff there is around or where it's being kept. So the Chinese central bank, pretty big holder of gold via the government, announced recently, at the time this video was shot, it's holding 1,658 tons of gold. And the market was surprised. We weren't expecting that, even assuming you can believe the number officially published by the Chinese. So, it makes you wonder, who's actually keeping tabs on where this stuff is. And if you're not sure how much of it there is around or who's got it, that makes the supply side of the equation a bit tricky to monitor. If you think the same is true of shares, not so, because there are only so many BP shares out there, and pretty much anyone in the market can give you that number. Yeah, the price moves, but there's no uncertainty about the number of shares in issue. With gold, a bit trickier. Then there's the demand side, which is pretty hard to predict or measure. And you can say that is true of any asset, but gold is particularly true. Give me an example, and it's not intended to be a flippant example. At the time this video was being shot, if you looked for media descriptions of demand in the Indian market, you will have found the following words being used simultaneously: weak, tepid, growing, rebounding. What are you supposed to conclude from that? And India is quite an important market for gold with jewellery requirements and so on. So yeah, the price is ultimately a function of supply and demand, but actually getting to the bottom of what's happening on the supply and the demand side is pretty tough, and it's not the only commodity of which that's true. Top of that, it's a complex market. There are lots of participants. Now, this is not a gold degree course, but just to give you a flavour, there are mines and miners. They don't do any buying. This is the point. It's the influence on the price. They don't do any buying, but clearly they're doing lots of selling for jewellery, investment, industrial production and so on. Then you've got industry, which needs gold for electronics, dentistry and a load of other uses, but they also sell it in the form of recovering scrap, deconstructing stuff that's gold in it and recycling it, if you like. So that's kind of buying and selling. Then you've got jewellery, which is taking the stuff in, obviously to make jewellery, buying raw material, but also there's a lot of scrap recovery. People, sometimes the price goes high enough, will suddenly start pulling gold literally out of their houses and selling it through pawnbrokers and so on, which makes it quite difficult sometimes to judge how much there is in the market or how much there's about to be in the market. Investors, going to come back to those in a moment, which is why they're in green. They can be either buying or selling, so creating inflows or outflows. And then central banks, holding variable amounts of gold. The Chinese surprised us recently, for example, as a way of backing currencies and so on, depending on their motive. Now, that means there's quite a lot going on in the gold market. There are quite a few different players, and a number of them can be listed at any one point in time on both the buy and the sort of sell side. So quite a complex market. And if you think, well, how difficult is it? It is pretty difficult. People have been caught out horribly. Two brothers many years ago got a double whammy when they tried to corner the silver market and failed miserably because they completely underestimated the potentially short-term supply that would come onto the market when the price hit a certain level. So trying to corner the market got them into trouble with the regulator, and they lost a lot of money on top. Kind of a bad day at the office there. Now, other factors that investors may factor in. So let's go back to investors. Here's the problem. What are investors thinking about when they buy or sell gold? Let's look on the buy side, for example. And the answer is, could be any number of factors. QE, money printing. There are theories around that all this money printing by central banks has pushed asset prices up, and some of that funny money, if you like, has found its way into the gold market. Maybe. Is it inflation? Some people think that if the world is about to end, metaphorically, if you like, if fiat money, notes and coins are about to lose their value in purchasing power because of QE, because of messing around by central banks, you're going to get inflation released. Some people think that gold, as a real asset, you can pick it up and kick it and put it in your pocket and take it away and store it, is protection against inflation. But studies have been released that show that it isn't a brilliant inflation protection because it doesn't pay an income, and that can be a bit of a problem. Is it fear? As I say, the media loves picking up stories that frighten investors, and there are loads of those in that massive bull run I mentioned. So, is fear driving the gold price? And I don't think fear is a terribly satisfactory basis on which to make an investment decision, if I'm honest. Is it the price of silver? Then you get the gold bug saying, actually, what you need to look at is the ratio between silver and gold. These are the chartists, if you like. When it gets out of kilter, you buy or sell. I've even seen theories saying it's something to do with the price of houses, the gold to house price ratio. Or is it the US dollar? Now, if you want me to pick of the last three, a likely candidate, but I can't prove it, that's probably the most likely, because if you were to plot gold against the US dollar and By the way, gold is priced in dollars, which is quite a big factor if you're, say, a UK investor buying gold. It's always priced in dollars. Some people have said, oh, look, recently you've seen the dollar go in one direction and gold go in the other. So maybe it's the direction of the US dollar and what that says about the US economy and confidence and interest rates potentially rising in the future. Maybe that's what's pushed gold back down from its heady heights of $1,900 an ounce. But no one actually knows for sure. And if they claim they do, then best move on. Then you hit the problem of all the ways you can buy gold. All right, and I've just mentioned the main ones here. You could go out and buy physical bars and coins if you think you've got somewhere safe to store them, you know what to do with them. You can buy it by jewellery, mining shares, commodities funds that are actively managed, that do a bit of gold or a lot of gold, derivatives market, you can get access to gold there. And then the way quite a few people did it, based on my earlier slide, some sort of exchange traded fund, so a share that tracks the gold price. But even then, if you're thinking, well, that's simple enough, a share that tracks the gold price, some of them track physical gold and some of them track using a kind of futures market approach. So you're either getting your access via something which tracks the physical or via something that normally tracks futures. So even there, you can get differences in terms of the way those products behave. So it's quite complicated and there's quite a lot going on. So what do we conclude from all of this? Because I've been throwing you a few issues around deciding whether you want to be a gold investor. For me, gold can be seen as purely speculative. For a lot of people, it lives in that basket because of some of its flaws compared to, say, equities, bonds or property, for example. However, I would say one thing about gold, and that is that anecdotal, to some extent, evidence suggests it has a low negative correlation to equities. If we look at recent market movements, for example, since August 2011, when you saw gold sort of start to plunge, it's down 40%. The S&P is up around 80% in that period. So, as a small part of a portfolio you're not going to worry too much about, maybe there is a place for something like gold as a kind of diversifier away from, say, a heavy equity component, and that's where you get the kind of insurance policy argument. But if you're only putting a small part of your portfolio into gold, you're not going to get insurance for the whole lot. It's going to offer a little bit of a buffer, if you like. So for some people, purely speculative. For others, yeah, there is a place for a wee bit in a portfolio, provided it's a fairly small part, as a sort of diversifier. A lot of ground covered there. Any questions, please email.